السلام عليكم ورحمة الله وبركاته. الحمد لله رب العالمين والصلاة والسلام على النبي الأمين وعلى آله وصحبه أجمعين. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي. Dear brothers and sisters, in this chapter, I'll be discussing on the fundamentals of risk and return. So it will be basically how to calculate the risk and the return. As we know that the investors are risk averse, which means that a rational investor would like to mitigate his risk or minimize his risk, and at, he wants to get the highest return possible with taking the minimum amount of risk. Okay, so if we want to calculate the return, simply the return of any asset, usually how we the in terms of the dollar return, we call it the dollar return, means how much dollar we get as a return from that asset. Is usually we calculate the capital gain or loss plus the distribution. Distribution is either the dividend from the shares or the coupon payment from the bonds. And if we want to know the rate of the return, we need to get the again capital gain or loss plus the distribution, and we need to divide by the purchase price of the asset, means the price we bought it at the beginning. So that is the simple understanding of how to measure the return. So now we have something called holding period return, means if we hold an asset for a certain time, if we want to know the return in that period, so the calculation will be the ending price minus the beginning price. Ending price means the price at which price we sell the assets, and beginning price means at the price that we bought it at the beginning, plus the dividend that we receive during the period we hold the asset, and we need to divide it with the beginning price and multiply by 100, so we'll get the percentage of the return during the period that we hold the asset. So here is an example. So assume that you have bought a share of stock company X and paid USD 20 for it. In the period during which you held the stock, you receive a dividend of USD 1. So you held the stock for 1 year and sold it for USD 22 afterwards. So what is your return? So the answer will be, we need to take the ending price, which is USD 22, minus the beginning price, which was 20, plus the dividend that we receive, which is 1, and divided by again the beginning price, which is 20, and multiplied by 100. So we got 15%. So 15% is the holding period return of the stock of company X. Now, if so, holding period return will give us the understanding of the return of an asset for a period. Okay, it can be for it's a time that we hold it. However, if we want to know the return for a multiple periods, for example, we hold it for a few years, so we want to know how is the return every year. Okay, so then we need to use the arithmetic mean. So this is the formula for the arithmetic mean. We need to sum up uh, the x, which is the all period return, plus and then the divided by the n, means the number of the periods. However, this arithmetic mean, it has some disadvantage because it ignores the compounding. So means that if we reinvest the profits or return that we get from the first period, and if we reinvest it, so actually the percentage of return would be little bit different, but this arithmetic mean doesn't consider that. So let us look at the example. So here is a periodic cash flows of an asset where say it's a quarter, it's a quarter. So at the first quarter, there's a return of 10%. Second quarter, there is 12, and third quarter 5, and the fourth quarter, actually there is a loss of 2%. So if we want to get the return, okay, the arithmetic return, which is actually the average return per period. So we just need to add all these returns. So we add 10%, 12, 5, and then the minus 2%, and divided by the number of periods. So there are 4 periods here, so divided by 4. So we got 6.25%. Okay. However, here, as I said, there is a deficiency in this calculation. So because you see at the first quarter, when there is a 10% return, so if that 10% is reinvested at the second period, so maybe this 12% here is the capital at the beginning plus that 10%. But this arithmetic mean does not include that, so there is a deficiency. That's why we need the geometric mean so it corrects the deficiency in the arithmetic mean. So it will take into consideration if we reinvest the profit. So here is the formula for to get the geometric mean. So we need to uh, put 1 from the formula, 1 plus the return for the first period, and then multiplied by 1 plus the return for the second period, and it goes on. And then there's a bracket to the power 1 divided by n is the number of the period, and then there is minus 1 from the formula. So if we look at the data from the previous table just now, we see, okay, so if we take the data from this table, so if we can add up, so we put into the formula, so we add, so for first period is 1 plus, okay, 10%, second year 1 plus 12%, third period it is 1 plus 5%, and the fourth period is 1 minus 2 because there is a loss. So if we add all of these, and then we to the power, and here the to the power 1 divided by the n is 4 here because there are 4 periods. So we divide 1 divided by 4 is it will be 0.25. So if we add all these and then to the power 0.25 minus 1, so we'll get the answer is 0.06, which is actually 6.11%. Just we need to multiply with 100 if we want to make it percentage. Okay, and then we have effective annual rate. Uh, Effective annual rate is accounts for the time value of money. As we know that the time value of from the time value of money concept, that the money that we receive today is more valuable than the money that we'll receive in the future, with because the money can earn profit. Uh, so why we need effective annual rate? So it will help us to compare with other types of investment returns and at a different period. So in order to get the effective annual rate, we just first need to get the annual percentage rate. Means that it is just the um, uh, we have to get the periodic rates. So if let's say it's a monthly or quarterly profit or even interest rate, we get that rate multiplied by the number of periods in that year. If it is 12 months, so we multiply by 12, or it's a quarterly, we multiply by 4. And after we get this AP annual percentage rate, then we can put it into the formula for to get the EAR, or effective annual rate. So in order to get the effective annual rate, we need to follow this formula where 1 plus the APR, the annual percentage rate, divided by the N, the number, means how many period in that year, and then to the power N minus 1. So again, the N is the number of period. So with this, following this formula, we'll get the annual return considering the time value of money. So here I'm giving you an example from a credit card. Okay, so usually when the credit cards, okay, they will charge a monthly interest, right? So assume that you have a credit card that charges you an APR, means annual percentage rate of 1% per month on purchases. Okay, and also assume that you do not pay the full balance immediately when it is due, and thus incur finance charges on a monthly basis until you pay off the balance. So what is your APR and EAR? Okay, so to get the APR is just we multiply 1% with the 12 months, so it is 12%. Okay, so usually uh, the banks, they will tell us that it is a 12% interest per year that we have to pay, because every month we pay 1%. But if we consider the time value of money, if we apply this formula of EAR, effective annual rate, so we can see that actually we pay more interest, which is actually 12.6%. So the formula here, we put a 1 from the formula plus 12%, okay, which is the APR divided by again the number of months, which is 12 to the power 12, the n number of the month minus 1. So if we calculate, we get 12 uh, 12.6%. So this is the actual rate that we actually pay when we pay for our credit card. So usually what the banks do when in credit card, they will show us the APR. They will show that we have to pay less price. But at the investment sides, in terms of return, if we have a deposit and we get a return or investment account, usually the banks will show us this one, the EAR. So this is actually more accurate, but some of the financial institutions, they may deceive us uh, by giving the APR. So we need to be careful on this. Okay, now after we get the APR, we also there is another need to keep in mind the inflation. Okay, so if we want to calculate the real return, which considers the inflation, then we need to follow this formula of the real return. So uh, real rate of return is something which considers the inflation. As we know that the inflation will decrease the value of money. So if in a year we have a profit of 12%, but in that year there was inflation of 2%, so our real return is actually 10%. So before this, the holding period return or others actually gives us the nominal rate of return. So in order to get the actual return is um, we have to get the nominal return and minus the inflation rate. Okay, so this is the formula for the real return is 1 plus the R is the nominal return and divided by 1 plus the I inflation rate minus 1, then we can get the real rate of return. And here is an example of inflation in Malaysia from 2007 to 2020, and we can see the highest inflation was in 2008, and then we can see more or less it's between 2 to 3% of inflation until 2017, and then from 2018 to 2020 the inflation rate was quite low. Even in 2020 there was minus 1.14, means it was a deflation. So if we want to understand our real return, we also keep in mind the inflation. Usually in the context of Malaysia, like the nominal return from the share market is 12%. But if we consider the inflation, so it will be around 9% per annum. Okay, so once we have learned the holding period return, so we also need to calculate the expected rate of return. As we know that all the investors, they are risk averse, means they want to get the highest return, okay, with taking the minimum amount of risk. So this expected rate of return is the weighted average holding period return on an asset, where the weights are the probabilities. So expected return, we calculate against different type of the probabilities, and we make an average of it. So it is the forecast of the average return on the asset against in different kind of economic situation. So here is a table for expected rates on return. So uh, let's say if we have an asset stock of X, so this is the probability distribution of that. So we assume there may have a three situation in the future, either boom or normal or recession. If the economy booms, and there is a probability for that which is 50%, and the probability to be normal is 30%, and the probability to have a recession is 20%. And if there is a boom, there is a probability of getting a return of 25%, and if the normal is, there's a probability of return of 10%, and recession based on 5%. Of course, all these the probabilities and also the holding period return that we expect here is actually based on the experience of the investors, or maybe based on the historical returns, and also based on our understanding. It's subjective, and it depends on the understanding of our economic situation, uh, and so on. But it may not be true even in the future. But we need to calculate based on our observation and experience, so this is the probability that's given by those who have experience in investments, and they can forecast based on that. So now, if we want to uh, calculate the expected rate of return based on those the probabilities, so um, based on the data in the table, we can compute the expected return of stock X based on the following formula. So is the sum of the holding uh, period return multiplied by the probabilities. So from that, and here the sum of n is the number of outcomes. So, based on the data in the table, if we want to calculate the expected rate of return, so we need to get the holding period return is first it was 25% multiplied by the probability, which was 50%. Okay, we multiply and then we add the second during the time of normal. So it's 10% return and the probability is 30%. We multiply and then at the third scenario as a recession, there will be minus 5% multiplied by uh, 20% probability. So if we add all of these, we get 0.145, which is 14.50%. So this is the expected rate of return. So we calculate it based on the probabilities and also the expected rate of return in those scenarios. So now we need to know the expected excess return comparing with the risk-free return. As we know that risk should come with a return. So if someone is taking higher risk, he should get higher return. So there is something called risk-free return, which is the return that we receive from money market instrument or treasury bill, or even the investment accounts return. So usually the treasury bills return, which is actually the government's bond, so that return is considered risk-free. So if we want to know that how much the excess return that we get because of the risk that we take, we need to deduct our expected return from the risk-free return, then we can get our excessive return. So here, so in our last calculation, we got our expected return, which is 14.5%. So now if we and then we got the treasury bills return is 3.7. So we can get this the treasury bills return from the central bank's website. So let's say is 3.7%. So the excessive return that we get in that share of X is actually 10.8%. So this is the excessive return we get because of the risk that we take through holding this asset. So this is actually the premium, the risk premium that we get for taking excessive risk. Okay. So now we measure the risk as well. So when we no return, and then if we can measure the risk, so we can also measure that how much profit we should get based on the risk that we take. So the risk is basically the possibility that the expected return may not be realized. So that is we call risk. That's what we expect that may not realize. There are how many percentage of the of chances that we may get it or we may not get it. So investors, they typically are able to quantify the risk of a security using the simple measure of variance and square root or standard deviation. So the investors, they will use the standard deviation to calculate the risk. So standard deviation is the most useful and meaningful measure, as we'll know from statistics that standard deviation will give us the how much it is deviates from the average or from the mean. So we can know how much it fluctuates. So if the standard deviation is higher, means the asset has higher risk. If it is low, means that the asset has a lower risk. So to measure the risk, we need to get the variance first, and after we get the variance, then we just square it. So standard deviation is actually the square root of the variance. Now, so for how to get the variance, so variance formula is here, is the sum of the holding period return that we learned before minus the expected return and bracket to the power 2 or okay or square and multiplied by the probability. That probability will be given based on our observation. So based on this, if we take the data from the table previously, that in three scenario, boom, normal, and recession, this is the probability as we got, okay, and then the holding period return in this three scenario. So in order to calculate the variance, okay, we have to get the holding period return here 25% minus the expected return. Remember, we calculated the expected return just a few uh, minutes ago. We got 14 something, so we take 14 here to make it easy. So we deduct this expected return from the holding period return, which is 25. Okay, after that we got when got 0.11, so we square it, so we get uh, 0.0121. Okay, and then following the formula, this 0.0121, we need to multiply it um, with the probability. So here the probability is 50%. So we get the answer 0.0061. So we do the similar for normal, okay, for boom, for normal, for recession. So we follow the similar steps here, and so once we get the answer for here, for the normal, and then for the recession based on the same approach, so we need to just add up. So here we add up all of these answer, we got the variance. So once we get the variance, so we just use the square root of this, so we get the standard deviation, which is 11.70%. So you get this answer 0.11, but if you multiply with 100, you will get the percentage. So this is 11.70 is the risk. Now we have another thing is coefficient coefficient of variation or CV. So this measures the risk per unit of return, means that how much risk related to uh, per dollar. So it will be easy for us to compare with other assets risk. So that one, the formula is quite easy. You just take the standard deviation and divide by the expected return. So we'll get the CV, or the coefficient of variation. So it will help. It will give us the result that how much risk is there in $1 of earning or return. So it will help us to compare with other assets. So now when we measure the risk, uh, so we need to also measure something called the required return. So as we know that if we take higher risk, we have to get higher return. So we have got in the standard deviation calculation is the risk is 14% something. So if we take that amount of risk, so how much return we should get? So what should be the risk, the premium for the risk taken? So as we know, the investors, they require additional compensation for investing in riskier assets. Riskier asset must have higher expected return. So let's say, as an example, if we invest in an utility company, for example, in the context of Malaysia, if we invest is Tenaga, for example, so it is a utility company and it is a big company. The risk is lower, so they may not give us a very attractive return. Okay, but if we go for a company that's is a risky, it's a small company, for example, and it is also highly competitive. Maybe is for example, is in technology. For example, we can give example of My Easy, for example. So if we buy their share and it is risky, so we expect the higher return from that shares. So that is so how much actually we need, we can get how much we return we should get, we can calculate it through the required return. And there is a formula for calculating the required return. For example, one of them is capital asset pricing model, and others. So that one will be discussed in a later chapter, inshallah. So again, in this chapter, I have just tried to explain the basic calculation for risk and return of an share or any financial asset. So I hope it clarifies. So with that, I thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.